Welcome back, everyone, to Fox Markets Live. My name is Paul Hurl. I'm delighted again to be able to speak to William Tamworth of Artemis. So welcome, Will.
Thank you very much, Paul. Delighted to be back here.
Yeah, well, it's great to have you on the show, particularly given all the sort of the economic uncertainty being thrown around by Donald Trump, which has been rocking the markets of late. So maybe we can start there. What's your sort of like broad outlook for UK equities going forward, particularly in your sort of sweet spot of small and mid caps?
So look, I would say tariffs are a negative, and uncertainty is a negative. On an absolute basis, it's hard to argue with either of those two points. But from a relative perspective, actually the UK is for once quite well positioned in that we're relatively small exporters of goods to the US. Only about 60 billion of goods go to the US. And secondly, and this is really important, a weaker dollar and lower energy prices are helpful for UK inflation, and that means that interest rates potentially are able to come down sooner. So that's actually, the UK is relatively well positioned. And then I would say small caps within the UK, which is the bit of the market that Mark and I look at, are particularly well positioned because 60% or so of revenues come from the UK, only about 15% from the US. And fundamentally, I see this as a US issue rather than a UK issue, albeit there are, of course, global implications. And I'd also say small caps are nimbler, more agile. Historically, they've bounced back faster from periods of uncertainty or from recession. So again, I think that means they're relatively well placed. And as we've been saying for a while, the UK economy is actually in a pretty good position at the moment. You look at consumers, their real incomes are rising, unemployment's low. The bit that's missing there is confidence. Again, businesses, balance sheets are strong, but business confidence is low. Politics, actually, we've got a relatively stable government, particularly when you look at what's going on elsewhere that's in place for another 4 years or so. That seems like a relatively good position to be in. So look, we're really excited about the opportunity at the moment. We see a portfolio trading on a 8% or so free cash flow yield, 11 times PE, growing double digits with minimal leverage. So the median company's not forecast to have any net debt. So yeah, we're very excited at the moment.
Yeah, well, I love that optimistic approach. In fact, I think I've ever known a sort of like a happy or a rich pessimist ever. So being optimistic side makes fun. Now, you raise a really, really good point, which I hadn't appreciated fully. The UK, you're right. If the oil price and gas prices go down, plus you've got a weaker dollar and therefore input prices, if that means inflation remains subdued, then are we likely to see interest rate cuts later this year? What do you think by the Bank of England? We got this for Thursday, in fact, I think, a decision.
So look, first of all, I should caveat, Mark and I are very much stock pickers, not macro economists. But we do get the benefit of speaking to lots of companies, so we hear what CEOs and what companies are saying. The next inflation print, the April inflation print, will be materially higher than the March one, and that's kind of we don't know exactly what it will be, but just the base effect and the impact of national insurance, national living wage, etc., mean that the next inflation print will be higher. But then after that, as you say, lower energy prices are meaningful positive for inflation, and indeed the weaker dollar. So yes, we do think interest rates will come down most likely this month, and then again through the rest of this year.
And the UK going to get on the front of the line for the trade deal with Trump? What do you reckon? Ahead of particularly ahead of China, I imagine, because as you say, we're actually not in a bad position because we're not linked now to Europe because of the Brexit. I mean, one of the silver linings of Brexit is that we can actually do these things independently.
So look, it would be helpful, but because it's only $60 billion of. And that sounds like a big number. It's not a big number in the context of the UK economy. $60 billion of goods being exported to the US is not a huge number. A far bigger thing is the uncertainty that this creates and businesses not knowing whether to send goods to the US or not. So it's dealing with the uncertainty is the bigger challenge rather than a deal that may or may not be in place, and indeed may not last very long with this government.
Yeah. Okay. Let's move to a bit of M&A, because we've had quite a lot of announcements this morning. We've had a bit of the US barbarians at the gate. We've got DoorDash, which has obviously agreed an all-cash bid, 2.9 billion for Deliveroo. But also, I know one of your stocks, in fact, I think your largest position has got I think it was probably an unsolicited bid or attention from US player Corpay, Alpha Alpha International Group, I think it is now called. It basically is a Forex dealer and stuff. It's been rejected by the board. I don't know, are you any thoughts about the broader M&A picture, plus obviously anything on Alpha? It's obviously been rejected.
So first of all, on the broader M&A picture, we've had 33 takeovers in the fund over the last 6 years at an average premium of very close to 50%. Now, to me, that says three things. It tells you that the third-party acquirer is taking a more positive view on the outlook than the wider UK market is. Important. I think it tells you that the traits that we like, so as I think we discussed last time we met, we like companies with strong market positions, market-leading positions in their niches, strong balance sheets, strong cash flows. Those are the types of traits that we look for. Those are attractive to acquirers. And then it tells you that valuations in the UK market are not a little bit wrong. They're nearly 50% wrong and very, very materially mispriced. And Alpha is kind of one of many in that that have attracted attention. Now, we don't know what the offer price was, so it's very difficult to assess anything about that. But we do know that Alpha's trading on a 8% free cash flow yield. It's got a quarter of its market cap in net cash. And it's got an unbelievably strong growth record. And we can talk about Alpha in more detail, but that to me is a very attractive asset at an attractive price, which of course other people are going to be interested in that.
And with all those other 33 deals you've been doing, presumably, you've been redeploying those into UK small and mid caps, haven't you? Because I mean, that's been one of the problems we've had in terms of sort of like, money's been exiting the whole small UK small and mid cap, but presumably it's music to your ears, isn't it, when you get more cash and you can then redeploy to even cheaper companies?
Yeah, I'd say that we're not seeing any shortage of opportunities to redeploy that money in similarly attractive companies that are similarly undervalued. And that's really, really important. Obviously, we would rather we weren't in a position of having to sell companies at best case. Most of these deals are at fair value. We're not jumping up and down with excitement saying these are really good prices, but we're selling them, let's say, close to fair value. But we can redeploy those proceeds, as you say, materially below fair value, and that's why it works, as you recycle the capital around. But generally speaking, we're not delighted with the prices that lots of these businesses have been taken out at. Yeah.
Well, as I say, if you can have the opportunity to upgrade at lower prices, then it's got to be good. If anybody wants to ask Will any questions, please put them in the chat bot and I'll read them out. I've had a few already. Let's move to a very good sector that's worked for you. Let's go to defence. We've got Babcock, which does sort of like a lot of the MOD services. I think it won a contract out in France as well, but it sort of services and maintains, I think, the sort of like the frigates and the submarines for the UK down in Devonport Dock and a whole bunch of other stuff. It really has done extremely well for you. What's your latest view on Babcock International?
So look, we've got close to 10% of the fund invested in defence stocks. And I think it's really important to say up front, this isn't because we had any foresight into what was going to happen in Ukraine or in anticipation of European rearmament.
You're too modest, Will. You're too modest.
But we were able to buy these companies at very attractive valuations when they were out of favour, and that's the point. It's not that we had any foresight; it's that we could see valuations that were attractive, and that enabled us to get ahead of that. Now, Babcock is, you said it. They do the maintenance of frigates. They have an extremely entrenched market positions. They're the sole supplier of nuclear submarine maintenance to the UK. Now that's not something that you can switch easily from one provider to another. They own the Devonport infrastructure, so very strong market position. And it was a business that had run into some challenges under the previous management, aggressive accounting, the cash flow had dropped off. But the two David Lockwood, David Mellors, came in a few years ago, and they really have turned the business around. To be honest, now it's 4.3 billion market cap. It's entered the FTSE 100. It's no longer a small cap, so it's probably closer to the way out of the portfolio than the way in. But as you said, it's been a very good investment for us.
Yeah, well, I mean, the shares have just been this year. It looks as though it's almost doubled, hasn't it? It's gone just fantastic. I mean, is that just strong performance? Is it people winning new contracts, going abroad, or just is that the sort of the extra defence budgets by NATO, which has been sort of like forced on, by, from Trump?
So I said it's a combination of defence going back in favour. So an anticipation of increased defence spending across Europe, that's one thing, but also better fundamental performance. So they've had a couple of trading updates this year where they've said that trading is slightly ahead of expectations. And for us, the really important thing is cash flow is substantially ahead of expectations. And that's the focus for us. Okay,
good. Well, let's move to, we'll just finish off. We've got on defence, we've got Qinetiq, which again is a services business, specialises in, I think, robotics and drones, and it sort of does training for drone training and testing, I think, for the UK government. It came out with a bit of a profit warning about 3 or 4 months ago, largely attributed to the Defence Strategic Review, and it hit some of its shorter cycle type operations. Its long-term businesses are fine. How do you see this one? It seems to have recovered a lot. It's over £4 now.
So the Qinetiq it's the old MOD research business. That was the background. And again, they've got some very, very strong entrenched market positions, particularly with the UK MOD. And the shares are trading on an 8% free cash flow yield. So very attractive, and the balance sheet's strong. And one of we talked about M&A earlier. Another theme that we're seeing across the UK small cap market, which is a new theme, is a number of companies doing buybacks at the moment. And Qinetiq are one of those companies. As you say, they had so the spike you can see on the share price chart there. That was people getting excited about defence companies again, and then the drop off was the profit warning. And really, it was uncertainty around the change in government, both in the UK and the Strategic Defence Review, which you referred to, and also in the US. Now, both of those things were known, but they've been worse than expected. And that, as you say, Qinetiq do have some shorter visibility work that they need to win each year. But yeah, to our way of thinking of it, an 8% free cash flow yield remains very attractive.
Yeah, and how long would you hold a stock like this? I mean, obviously it's got lots of secular tailwinds, and given it's an R&D centre, and it's very difficult to get your head around how much IPR, particularly when even if you go for a capital markets day or a site visit, they're going to put you in a corner and say, "I'm sorry, there's a locked door here. You can't come in because it's MOD. It's strictly confidential." How would you get your head around about the long-term value of this, rather than just looking at the numbers? How do you sort of put a number on the IPR in this?
So generally speaking, our time horizon for investments is 3 to 5 years. On average, we hold individual stocks actually a bit longer than that, about 6 years by name. So we are at the longer term end of the spectrum compared to many of our peers. And Qinetiq would be no different to that. We wouldn't have any different expectation for the time horizon for Qinetiq than any other company. I would say, even if you can't get into the contractual detail, which you're right, you can't, you can see the cash that the business generates. You can see the contracts that the business are winning. And if they're winning contracts, that's indicative they've got a proposal that is valued. And if they're converting those contracts into revenues and into cash, that's something that we can value.
Yeah. No, yeah, it just is. It's, I know American, over on Silicon Valley, they value like IPR and what you can't see under the financials a lot higher than the UK, and that's where some of that strategic value that you talked about with the bid premiums of being 50%. When somebody, a trade buyer comes in, they can see it, and then they can see value, which is all pure upside, isn't it, for you guys? Okay, good. Let's move to let's go to consumer service. We've got a question from Lemon Physical. He's asking about Moneysupermarket, which has been branded MONY, I think, or MONY, or MONY. Basically, the UK price comparison website did very well over the last couple of years when we had the cost of living crisis, and it helps consumers get the best deal for their broadband, electricity, insurance, car and home. And it used to do energy, but obviously it's been price capped. How do you see Moneysupermarket nowadays? It has actually come down. I was looking at the PE, and it's currently on about less than 12 times PE, which is a pretty good value actually.
Yeah, so the way we look at it, it's trading on a 10% free cash flow yield, which we would see as very, very attractive. It's another company doing a share buyback. It's another company with a very strong balance sheet. The bit that we're excited about, and I think we talked about this, Paul, last time I was in, is the changing from being very reliant on Google and TV advertising to try and reduce that reliance, both through Money Savings Expert, which is one of the websites that they own, and through the Super Saving Club, which when we spoke last time, they had 200,000 members in that. They've now got 1 million members in that. And what that does, it helps change a one-off switching revenue into much more of a recurring repeat business that's not reliant on spending money on ITV or on Google to generate that in interest. So that as they make that transition, that becomes a higher quality business. We would argue that's why we're excited about it. I think the short-term worries are about insurance prices over the last couple of years have been extremely strong. That's encouraged lots of people to switch insurance companies. That's been good for Moneysupermarket, and there's a fear that gets harder to repeat. My argument would be that there are other areas that have been pretty subdued recently. You mentioned energy. That's clearly been heavily impacted over the last year or so, but also their money business, their credit cards business, their loans businesses. As interest rates have been higher, conversion rates on those products have been lower. As interest rates come down, this is an area of the business we'd expect to benefit.
How important are dividends? Because obviously, I was just looking at it, it's got a 6% dividend yield.
So not important to the way we look at things. We're really, really focused on the free cash flow. So that's the 10% free cash flow yield that I talked about. And then secondary to that is, what does the company do with that? And whether it's buybacks or dividends or investing in other areas, provided those other areas generate sufficiently high returns, all of those options are okay with us. Okay, good. Okay, let's go to a similar sort of company. We've got Telecom Plus, which basically offers a full sort of like suite of services for telcos and broadband and energy, and puts it all underneath its utility warehouse brand. I think it pays a pretty good dividend. Yeah, nearly 5%. Again, trades at about 15 times actually, but it seems to be keep adding to its subscriber base. How do you see this one going forward? So it's an interesting corollary actually to Moneysupermarket, in that Moneysupermarket benefit from consumer switching. Telecom Plus benefit from consumers not switching. They benefit from loyalty. But the reason it's interesting is because they can offer multiple services. So broadband, mobile, electricity, gas, insurance, multiple services across one overhead base. So they, rather than having to recover the overhead against each individual service, they can recover the overhead against a number of services. And that means they can be very competitive on price. And they've grown their customer base at double digits over the last few years. And importantly for us, the cost of doing that, the cost of the capital cost of doing that is very low. So they generate very strong cash flows even as the business grows, and they can pay that all out as dividends, which is a very capital light model.
Yeah, and we looked just on both of them actually. We've got Telecom Plus and Moneysupermarket. They seem to do really well in periods of higher inflation, which encourages people to, either look for sort of cost of living crisis type of savings on both on the switching, or actually to go for a broader sort of package and stuff. But they're both sort of shares that have dipped when the inflation has started to come more out of, more under control. In a sort of like a lower, if we had a 2 or 3% steady state inflation, which is a big if, but if we did, are these guys going to? How do you see them sort of like benefiting or performing?
So Telecom Plus, I don't think inflation matters that much. What matters is how competitive their offer is versus others. And we had a 5 or 6 year period before the Ukraine crisis, where energy companies were able to offer extremely low tariffs, even versus the price cap. There was a huge gap between the standard variable tariff and the sort of teaser tariffs that people were able to offer on an unhedged basis. Telecom Plus struggled in that environment, but that's materially changed now. The regulations have changed, the capital requirements have changed, the hedging requirements have changed. So it's much, much harder now for a new energy company to come in at a tariff that is very, very competitive. And that for me is the bigger difference, Telecom Plus, over the last 3 or 4 years, rather than inflation.
Yeah, you raise a really good point there. That's why all the big energy providers, the big four, the likes of British Gas or Centrica, are doing so well, because you're right, a lot of the unsustainable competitive business models of the effectively virtual type of energy providers, they've just blown up, and they're just not allowed now, because the government doesn't want to have to mop up the mess when there's a spike in energy prices. Okay, let's move to Moonpig. Let's go to the sort of like the DIY online card poster child of sort of like card services, whereby consumers can log onto their website and create its own, run your own personalized card. Been doing that. It's got a business, I think, along with the UK, out in Holland. Plus, it now does gifts and stuff. The shares have actually done pretty well. What's the sort of the outlook for this business?
So they are, I mentioned earlier, we like market leading companies. They are 3 or 4 times the size of their next biggest competitor, both in the UK and in the Netherlands. Yeah. So in the UK, Funky Pigeon is the next biggest, and Moonpig are multiple times the size of them. And the reason that's important is it means you get better data, which means that you can, so you talked about the gift attachment, you can recommend better gifts to attach to your card, but also reminders. So Moonpig now have 96 million reminders each year. That's me trying to remember my godson's birthday or my wife's birthday, whatever it is. And because it can remind me of those events in advance, it prompts me to buy a card. So it turns a one-off purchase into a repeat recurring purchase. And because it knows not just when that date is, but it knows often who it's for, how old the person is, it can then recommend a gift to attach with those things. Now, I think there's a long way to go before we get to the potential on the recommendations. I think that it's not as good as it could be, and indeed will be. But that's where the excitement comes in this in this story. It's the data you get from being the market leader. Yeah.
And would ever be sort of disintermediated by things like generative AI? Because if I had a sort of like an agentic AI bot in my pocket, on my smartphone, and it basically knew who I wanted to send cards are or presents and this sort of stuff, then it could automatically, effectively prompt me and do it, and be effectively my own personal concierge service.
Yeah. So I mean, sorry, Moonpig have some of those AI elements anyway. So I think the point is, in the UK, we are an economy that likes sending physical cards and physical presents. That's not the case everywhere. E-cards are more popular in some places than others. But from a physical card perspective, Moonpig are able to use AI, and there's a very clever handwriting element
Yes.
there. You can write some handwriting, then they can copy that and then use that on the cards. They can come up with poems or things you might want to write in cards, again using AI, but they're doing some of the things that you say, those recommendations automatically for you anyway, and that will get cleverer, but ultimately you still need someone to print the card and to send it, and that's where Moonpig comes in.
Okay, good. Let's go to, as we're approaching the summer holidays, let's go to all things sort of like package holidays. We've got retail, UK online retailer Onthebeach. Shares have been really, really strong. I thought we were reaching, last time we spoke, sort of like peak travel, but I was totally wrong. The UK public wants to go abroad, both on summer holidays, winter holidays, city breaks, you name it. Again, how do you see Onthebeach faring in this summer? It seems to have had some of the people are actually buying holidays a bit later than they have done before, but I don't think that doesn't seem to be a major problem. Anyway, what's your thoughts?
So, unlike airlines, they don't own. Onthebeach don't own any infrastructure. They don't own any hotels. They don't own any planes. It's a virtual business. It's very, very capital light, and that means it can flex up and down with demand very easily, and it doesn't suffer the huge operating leverage of airlines or hotels. I think that the share price chart you've pulled up there is partly a reflection of just how unloved this company was and how low the valuation was at the beginning of that period. To us, it's still on an attractive valuation. It's on I think 8% free cash flow yield. It's got a significant net cash balance. It's another company doing a buyback. But the consumer, to my mind, is in a better place than many people think. Unemployment's low, real incomes are rising, household debt's been falling for 17 years as a proportion of income, and people do want to spend some money on their summer holiday every year, and Onthebeach are a beneficiary of that.
How important is that sort of cash flow yield when you come to sort of buying? I mean, is it basically a must-have, sort of like a deal breaker type condition? Because if it is, the problem you get is if you invest in a really early stage and they've got fantastic growth potential, but they're not yet sort of like profitable, or even if they are profitable but they're investing in their IP or in I don't know, trials, medical trials, or they're also putting in physical infrastructure like data centers for AI. How do you sort of overlay that type of investment to further accelerate the top line growth into your investment thesis, or do you just write it off?
So it's really important to us. Free cash flow is absolutely critical, and it's probably one of our biggest differentiators versus many of our peers. And it will mean that we miss some really attractive early stage growth companies that we don't invest in because they don't have those cash generation characteristics that we like. But it also helps us to avoid some overhyped companies that then ultimately fail to go on to deliver. So we'll miss things, but it helps protect us in other ways, and we'll stick to it because it's a key part of our process.
Yeah. Okay. So in other words, you may miss things like Amazon at the early days, but you're hitting Nvidia and Apple, those guys, even though they're too big. Okay, good. Let's go to Warpaint, which is basically consumer cosmetics. Bit of a challenger. Done really, really well over the last 3 years. Fantastic management team. They've been expanding out into Europe, across the UK, into people like Superdrug, but now also last year went into the States with CVS and also with Walmart. Tariffs not massively helpful, albeit the US, I think, is still only about 10% of the business. Very popular share. How do you see this one sort of tracking over the next 18 months?
Yeah, so tariffs not helpful, as you say, but I think it's 8% of their revenues, 4% of their profits come from the US. So not hugely negative, albeit the US is an important part of their growth story. So that probably understates the importance of the US to the value of the business. The reason we bought shares in Warpaint, it was growing strongly in every market. It was growing strongly offline and online, and all their brands were growing strongly. So that sort of momentum that you rarely see in a business. They recently bought Brand Architects, which have a number of brands themselves, but it was not a profitable business. They had, I think it was about 17 million of revenue. They weren't making any money. Warpaint's management think they can deliver a similar level of revenue next year, not this year, with maybe half the number of employees. So dramatic cost savings, and then take that Brand Architects margin up to the Warpaint margin. So that's another tailwind, I would say, to the story. Another company with a very strong balance sheet. They've got net cash as well.
Yeah, no, they seem to be doing a great job. Absolutely, and I suspect we'll sort all the tariff stuff out in due course. And if this is the worst it gets, then it looks like a follow the trend. Yeah, the trend is your friend on this one. Okay, we've got a question from John. He's asking about property services business Mears, which I think it does all the sort of housing maintenance and servicing, a lot for the public sector. MOD, and I think he used to do a bit of the asylum as well, but also a lot of the housing associations. Good steady business. How do you see this one?
So the core of the business, as you say, is social housing maintenance, and the attraction of that is these are long-term contracts, 5 to 10 year contracts. They are largely inflation linked, so you're protected against inflation, and they're very defensive. This is ring-fenced revenue for social housing maintenance, and that's to us is a very attractive source of cash flows. Over the last 5 or so years, they've had a significant asylum contract, AASC contract, alongside actually Serco as well, are also beneficiaries of this contract, and that is a big part of the business now, and that's a risk to us because it's a material part of revenues, and there are both political risks associated with that, and also you don't want your business to be too reliant on any one area. But the company have been very good at managing expectations on that contract so that people haven't got carried away and extrapolated up into the future, and they've been able to use the cash flow the business generates to buy back a substantial number of shares. So the share count is reduced by more than 20% over the last couple of years at a very attractive valuation. It's probably one of the most extreme buybacks, certainly in our portfolio, and that's driving strong earnings growth. The business still has substantial net cash, and it's still, we would expect very likely there'll be further buybacks over the course of this year.
Yeah, it looks like a good valuation still. I mean, it's like nine times PE, 4% dividend yield. So still, even though the shares have appreciated significantly over the last couple of years, they're still reasonably valued. Is there any chance of them getting sort of like I don't know, put into that sort of like budget problems? I know you talked about it sort of with the public sector. I know you talked about it being ring fenced. But do they have any major competitors where they could get more sort of price competitive, or is it really just, as I say, inflation proofed? And if you wanted effectively an annuity stream, then this company provides it for you.
So it is price competitive. I don't want to say this isn't a competitive market. It is a competitive market. They make a 5 to 6% margin, so it's a relatively modest margin, and generally the competitors are smaller single service providers. There are very few people that can offer the breadth of service that Mears can, and Mears will be multiple times larger than their next biggest direct competitor on the social housing maintenance side. So of their biggest contract on the housing side is with North Lanarkshire. There are very few, if anyone, that could do a contract of that scale in the housing space.
Right. Okay. Gives them the economies of scale and barriers to entry, and to get higher. In fact, I did see actually their win rate of retaining contracts was 100%, wasn't it? Their big renewal rate just recently. So it just shows you how sticky those services are. Actually.
Absolutely right. Yeah.
Yeah. Okay. We've got Tony asking about basically property house builders. Let's start off with MJ Gleeson, affordable housing house builder. Also does a bit of property development in the northeast and in the in the Midlands. Housing market has obviously struggled a bit of late in the last 2 or 3 years because of high interest rates, and the government have now moved or removed the Help to Buy scheme at the end of March. So, but people are talking about green shoots. How do you see it? Have you seen any green shoots yet in early spring for the house builders?
So the government is very, very focused on growth. The rhetoric now has shifted from the dire inheritance that they received to growth. It's all about growth. And one of the areas that we're seeing most traction on, I would say, is planning. That is an area the government is already making significant inroads on. Now, there's a lot more still to do. It's still very challenging. But Gleeson is a business that will benefit from easier planning. They've got two businesses. They've got a land promotion business, and then they've got a low-cost, affordable housing business. So the average cost of the houses that they sell is less than £200,000. And I would say you don't need to believe the government gets anywhere close to their annual house building target to believe that Gleeson can very materially grow its number of housing completions from less than 2,000 per year at the moment. And the land promotion business, as planning gets easier, that business should accelerate as well. You're buying the shares on about 1x book, which historically has been a relatively attractive valuation metric to use for house builders.
Yeah, and I know they haven't got a huge direct cladding exposure. They've made provisions for it, etc., because they obviously do affordable homes rather than blocks of flats and stuff, or have done historically. So they haven't got a massive one. But in terms of, I know the government is thinking about putting, well, it isn't soon to announce a building safety levy on the whole industry. Nobody's talked about exactly what it's likely to be, but in their consultation paper, it seems to be carving out affordable homes to have zero levy, and then sticking everybody else gets the full sort of like, vanilla 100% levy on top of it for private sales. What sort of exposure would Gleeson have to this?
So this is a political sector, and we've seen higher corporation tax rates already applied to the house builders. Many of them have made significant provisions, and they're paying into the schemes to redress cladding issues from the past. Look, it is a challenge, but the counter to that is you can't get to the house building targets without a house building sector that is profitable and growing. And the government recognises that. They know that. So it's about getting the incentives right so the house builders can reinvest in buying land and building more homes and want to do so.
Yeah, no, I would agree. If they nail the house builders, then they're not going to get what they want. So, and it isn't as though the housing associations can do the heavy lifting because they've got no budget either. So, something's got to give.
And there are knock-on benefits of house building. It stimulates the economy in other ways over and above just the sale of the house.
Yeah, no, that's a really, really good point, because if Rachel Reeves wants to get growth going, which she says she does, then what's the best way of doing it? You get that multiplier effect, isn't it, on the house builders? Okay, we've got another one up in the northeast, smaller business. We've got Henry Boot, which basically does land development, house building, but I think it also does a bit of civils and maintenance and stuff on roads. Again, similar sort of chart. Is the thesis about the same? Interest rates and coming down, and they need the housing targets.
So Henry Boot is a frustratingly complicated business. There are lots of different components to it, but at its core is a land promotion business that has 105,000 plots, either owned or more likely under options. So they have the option to buy land when planning is secured, or they get a promotion fee when land is secured. 105,000 plots that are held at book, so they haven't been revalued up through time. And as planning gets easier, we'll see a faster turnaround of those plots into land they can sell to house builders. Now, they are already accelerating the number of plots they're submitting through to planning. I think they've done 10,000. They've gone into the planning system currently versus a normal year of maybe 2,500. And as we convert those plots into plots with planning, they're worth substantially more. And yet the shares are trading at a 30% discount to the book value. And the book value is not the market value of these plots. It's the historic cost of these plots.
So why that big discount? It's just because it's difficult to understand and people have migrated to the bigger house builders, and it's been that classic sort of like, I can't get my, investors haven't really spent the time to fully understand the business model.
Yes, I'd say it's an out of favour sector. House building has been a difficult place. As you talked about, higher interest rates, uncertainty, fear of recession, low consumer confidence. These are all things that hold back confidence in these types of businesses. And it has the double whammy of being a relatively complicated business. There is a small construction business at Henry Brew. There's a plant hire business, and people look at those and think this isn't a too difficult camp for a small business, and therefore overlook what's a really attractive land promotion business within that.
Yeah, good point. Good point. Okay, let's move to software and technology. Got Peter asking about GB Group, which I think is one of the world's leaders in identification, basically preventing things like ID theft. It's making sure the person who says who's online is actually genuinely that person. Also puts location services. They got a bid a few years ago from private equity at about, I don't know, £4, £5, etc. They're going through a bit of a sort of turnaround. They came out with some results, I think last week actually, and like for likes were in slightly positive, but it wasn't sort of rip-roaring growth. How do you see this one? Because I think it wants to get back to high single digits, double-digit like-for-like growth, organic growth.
So this is a business that Mark and I owned for many, many years. We sold out of it too early, of it, I think at the beginning of COVID, and the shares did extremely well. After that, and then we bought back into it in 2022, I think it was, so kind of when the shares had come well off their highs, and basically the valuation felt like it was too, or had become too stretching. And this was a COVID beneficiary. It benefits from more activity going online. During that period, they did a very expensive acquisition. They bought a business in the US called Accurant. They paid a very high price for that. So since then, they've been paying off the debt they took on to buy Accurant, and the comparisons that they've faced have been very tough because the sort of COVID period was never going to be sustainable as we transitioned back to a more normal economy rather than that very abnormal period that we had. If you look over the long term, it's a business that's generated double-digit organic growth, 10% plus organic growth for many, many years. And then it was better than that in the COVID period, and then it's been worse than that afterwards. But the long-term track record is very, very strong. And you're now buying these shares on a 7.5%, 8% free cash flow yield with a balance sheet that's now reasonably strong again. So having taken on the debt for Accurant, they've largely paid that off, and it's another company that's recently started a share buyback. So to us, this looks this looks very interesting again.
Yeah, what's going to drive the secular top line growth though? Because the fundamentals should be working its advantages, more online, more verification of people for banking and stuff like that. But it hasn't yet sort of translated into real top line growth, which is what you'd have thought. Is it pricing which is holding it back, or is it just the product? I don't know. It should be going at a stronger rate than it actually is.
So long term, it has. So long term double digit organic growth for many, many years. That's rare. You don't get that very often, and GB is something that has delivered that. In the short term, yes, there is some competition. There's some competition from private equity owned businesses that historically haven't needed to make money if they start needing to make money, then that's helpful. So higher cost of capital for private businesses, which we are seeing and we have seen, that's helpful. But also the comparisons that it's harder to grow off a period that was very elevated because of abnormal COVID boost. As time goes on, that works its way through. And I'd say we are now through that. So we should see growth accelerating. And things like AI make fraud prevention more difficult, but even more important. So that the need for their services, the need for genuine identity verification for fraud prevention are absolutely still as relevant as ever.
Yeah, good. Okay, we've got a question from Riffs Off. He's asking about Yougov. I'm not sure you own it though, do you actually, Will? Or do you, Yougov?
So we recently won the mandate for an investment trust, the Invesco, what was the Invesco UK Smaller Companies Investment Trust, now rebranded the Artemis Future Leaders Investment Trust, and they had a holding, a very small holding in Yougov, and it's actually a holding that we've added to in the investment trust. So it's a company that's got really, really good data. So they have a panel of people they ask all kinds of different questions about, which produces a really high quality and bespoke differentiated data that they can leverage in many, many different ways. Now, under the previous CEO, the business had struggled to grow, and this is an area that I think there is more low cost competition coming in at the lower end.
Yeah.
But at the higher end, it's very hard to replicate the data that they've got. The founder has come back to the business, and he's very confident he can turn it around and get the business back into growth. But the way we look at it, the chance of success as measured by the valuation, it looks like the market's saying there's no chance of this business being turned around, or very low chance of this business being turned around. And we are more optimistic about that. And the odds we're getting, i.e. the valuation, are very attractive.
Yeah. And just broadly, in terms of the split on that revenue you talked about, between sort of like higher value services that can't be cannibalized compared to those which are more commodity orientated and price sensitive, what sort of split is that? Are we talking like a 75-25, 60-40, 50-50?
So I think that the key is, what can you use the data for? So rather than custom pieces of research is lower value added in an AI world. Yeah. Because AI can do lots of it can extract data very, very efficiently, but the value of that data is more valuable. And if no one else has that data, it becomes even more valuable. And that's it's a shift in mindset away from, can we sell you a piece of research, to we're going to give you access to this data. You can use AI to extract the bits that are most relevant to you in a much more efficient way. And that's the transition that they are making.
Okay, good. We got a question from Sarah on again on IT. We got cybersecurity company NCC, which itself has gone through a bit of a turnaround over the last few years. Got two divisions. Got its IT cybersecurity consultancy division, which goes in and sort of like tests people like the financial banks, etc., see whether they can get hacked in, that kind of stuff. And then you've got this really base sort of cash flow generating escrow business that stores software packages securely online. And I think they've had an approach actually to buy that strategically. But putting those two parts together, how do you see this one going forward?
So it won't surprise you, given we've talked so much about cash flow, that it's the escrow, the software escrow business that attracted us. This is a high margin, recurring revenue business that generates lots of cash. The bit that it doesn't have is much growth. So it doesn't. People don't get excited about it because there's a lack of growth in the software escrow, but it generates lots of cash, and actually it generates almost all the profits of the group currently. The cyber business is a is much more of a consultancy
Yeah.
bit business, and as demand goes up and down, generally it's on an upward trend. But as demand goes up and down, you need to manage the utilization of those people, those consultants, very closely. And over the last year or so, demand has come off a bit. It's a very, very competitive space, and the margins have come down because the utilization hasn't been what it needs to be. Now, ultimately, that's something you can fix. You can get the utilization levels right, either by reducing the number of people you hire on, or demand grows to backfill effectively the utilization. So margins should recover there, and largely the valuation of the whole business is underpinned by the escrow business, and then you've got a recovery story as margins improve on the cyber business. But it's the escrow business that attracted us to it.
Yeah, you're right. And if the escrow business gets sold, it'll make it a simpler play then for potentially somebody, a private equity or somebody else, a trade buyer buying the consultancy. Because I think FD Technologies, or I think this ticker FDP, they just sold off their IT services businesses, I think, for a consultancy business for about, I think it was 10 times EBITDA. So you're right, it could be an unbundling play, this one.
So it could, but there's pressure on them to sell escrow. That pressure is not coming from us. And the reason it's not coming from us is you've got to make sure you sell these businesses at the right time where you're going to maximize the value, not just because there's shareholder pressure to. The value will still be there. Some of the parts value will still be there in a year's time or 2 years' time. You've got to make sure you maximize the value of that rather than be opportunistic and sell just because there's pressure from shareholders.
Okay. Well, we've been talking about lots of cash generation and cash flow metrics, etc. But you do have an interesting high growth business, high potential, is AOTI, which basically does sort of patented and unique sort of diabetic foot ulcer treatment out into the States. Got quite a big position with the Veterans Association, with Medicaid. Seems to be doing pretty well, but obviously there's been a bit of disruption out in the States in terms of releasing budgets and all this sort of stuff. I think the shares IPO'd last year at about 130. They've come off to roughly around about 75, 80p at the moment. Still as a Reg S, it's low liquidity stock. How do you see this one going forward? It just seems to have fantastic technology that the NHS also, they had a big report this recently, also seems to like, but haven't yet started ordering.
So hands up, this is one so far that we've got wrong. We bought into shares at IPO, and that's been a very poor investment so far. The biggest part of that, I would say, is the company's management of expectations has not been good enough. So actually, if you look back to what they've delivered over 30% revenue growth last year. That's a phenomenal achievement. They're guiding to close to 30% revenue growth again this year. And indeed, if you look back over the past few years, they've delivered something similar. That should be a huge success story. The problem is they promised slightly more than that. So it's disappointing because they haven't they haven't achieved quite what they set out to do. Now, if you look forward 3 to 5 years and this business continues to grow at that sort of rates on a very high 80% plus gross margin, this will be a very, very attractive investment. And the crucial thing for me is they have a high market share, 80% or so market share of their very little niche, as you said, treating diabetic foot ulcers using basically pressured oxygen technology. They have a high market share, and if they can continue to grow at anything like those rates, it's very attractive. And the reason we think it's likely they can is because they save the customers money. And the NHS spends about 1% of its total budget apparently on foot ulcers, diabetic foot ulcers. This is an enormous cost. And if they can improve patient outcomes and save money, then the scope for this to be a much, much bigger business. And as I say, with those high gross margins, as it scales up, it should be a very attractive investment. But so far, the expectations of management has not been good enough.
Are there any sort of other competing technologies? Because I know the big advantage of this technology is that it's a surrounding boot that can be used and treated to treat patients at home rather than in a hospital. But is there anything else coming out of the woodwork? Because just in case you get to 5 years and it's sort of tripled its revenues, but there's another competing technology. Is there anything of note out there at the moment for diabetic foot ulcers?
So not that I'm aware of it. And
yeah.
The depressing reality is that the number of amputations is extremely high in this area, and that's almost it's a very poor patient outcome, and it's very expensive. But that is what's happening at the moment.
Okay, good. Okay, well, let's go to a final one. We've got Stephen. He's asking about RWS, which has obviously been in the news of late. The CEO has just bought an absolute shed load of shares when the stock fell about 40% last week after a profit warning. Didn't seem too bad, to be perfectly honest, but still quite a large business. It does basically patent translations, technical translations, and website translations and stuff. People are obviously a bit concerned that it will get disintermediated by AI eventually. But having said that, people like Duolingo are doing really well on their sort of like, teaching people languages and this sort of stuff. But how do you see this one going forward? Very, very cheap at the moment.
So yeah, very, very cheap, and that's sort of polite way of you saying it's another one we've got wrong. And the share price has been very, very poor recently. You're right, it is cheap. Strong double-digit free cash flow yield. The new CEO Ben bought, I think it was 1 million shares the other day. That's often a good sign. We haven't actually met him yet. He's only just joined. The business got a strong balance sheet, very low debt. But I would say the confidence in numbers is extremely low. We've had a series of downgrades, and therefore people don't trust the numbers that are out there. On the AI specific point, RWS own the technology behind the translation software. So it's not just a translation services business, it's also a translation software business. And they're already using AI and machine translation, and it's their own IP, and it's done in a closed environment that people are much less worried about the security implications, because it's all being done in a closed environment. So they have a number of attractions, but it's proving to be more price competitive than we'd thought, and that was one of the reasons that's put the earnings under pressure. Yeah, looks very cheap, but the earnings, the confidence in earnings is low at the moment.
Yeah, well, it's paying if it does pay the dividend, we're not sure, but 8% dividend yield, six times PE ratio. I mean, it looks as though last week somebody just decided to dump a shed load of stock, which drove it down off a cliff, but it's either a buying opportunity or a value trap. I don't know. One of those things. Okay, good. Let's finalise and I'll finish on a winning note. We've got Beeks Financial Cloud. Deborah's asking about it. It does sort of like low latency sort of systems for high-speed trading. It puts these servers and software into exchanges, things like the Johannesburg, NASDAQ. It also does for a bit of crypto. It just won one with Kraken, I think, as well. So doing really, really well. Shares have come off a bit, which I don't know why, actually. But how do you see this one? Been a bit of a star, actually, over the last 3 or 5 years.
So it's been a phenomenal investment, albeit, as you say, the shares have come off more than a bit. They've come off quite significantly recently. I would say that the number one thing there is, again, expectations management. So this is a business that is growing very quickly, but not quite as fast as people were hoping. They lost a legacy contract. They also, the way that they recognize revenues is changing for some of the newer contracts. So rather than being paid an upfront fee, they're taking a revenue share, and that takes, if you're taking a revenue share, that takes longer to build. So ultimately you get a greater value from that contract, but less upfront on day one. The biggest thing for me on Beeks is the validation that they're getting from new customer wins. And you mentioned NASDAQ, the Johannesburg Stock Exchange. These are big contracts that are growing quickly and validating that the offer that the Beeks have.
Good. Okay. Well, thanks very much, Will. Just one last question. Out of all those stocks we've discussed, or any others you hold, what's your sort of your favourite idea going forward for the sort of the next 12, 24 months out of all of the companies?
So I will answer it, but just before I do, I said that it's in a small cap fund. It's really, really important to have a diversified portfolio and to use stocks to offset each other. So if you look at our top 10 holdings, they are deliberately a diversified group of companies, because that helps you mitigate some of the risks that you might otherwise be exposed to. Now, the stock I was going to mention, if you asked this, was Alpha Group.
Okay, which was taken out. It could be.
And the reason I'm sort of still going to mention it is because the shares, well, certainly before the meeting, hadn't moved very much on that. So I still think it's really interesting. The reason it's interesting is because they have about 2 billion of client cash sitting on their balance sheet, earning interest at about 4%. So 2 billion at 4%, about 80 million a year, and they strip that 80 million a year out of their underlying earnings. So that's 80 million of free cash flow that is not being reflected in their underlying earnings. Now, to my mind, that makes it look expensive on a PE basis. Fine, we don't look at PEs, we look at free cash flows. It looks very, very attractive on a free cash flow basis. 8% free cash flow yield for a business that's grown very, very strongly for a number of years, and it's got, I think, 25% of its market cap in cash. That's why I think that's an interesting stock.
Yeah, well, I think Predator Corpay also thinks is interesting. Will, it's obviously it needs to sharpen its pencil if the board are going to recommend it, I think. But good chat, and that is, just say, really well done on that one, because I think it's your top position, your biggest holding at the moment. So a nice way to finish off. So thanks again, Will, for all your comments and insights, and very much look forward in touching base again in 6 months' time.
Thanks very much, Paul. I really appreciate it. Thank you.